Most people think a mortgage is just a loan. It's not. It's a machine designed to extract decades of wealth. When you apply for a mortgage, the lender doesn't hand you cash on day one. Instead, they're evaluating risk. They pull your credit report, verify your income, assess the property's value. This process, called origination, determines whether you qualify and at what interest rate. Your rate isn't random. It's tied to market conditions, your creditworthiness, and the loan term you choose. A 30-year mortgage at 6% looks cheaper monthly than a 15-year at the same rate. But that difference in time compounds into staggering amounts of interest paid. Once approved, the lender funds the loan. You receive the money, typically wired to an escrow account, and it's dispersed to the seller. You now owe the full principal amount plus interest. This is where amortization enters. Amortization is a payment schedule. Each monthly payment is calculated to pay down the loan over a fixed period. The formula sounds simple: principal, interest, and sometimes taxes and insurance bundled together. But the structure is deceptive. In the early years, most of your payment goes toward interest, not principal. On a 30-year, $300,000 loan at 6%, your first payment might be $1,800. Only about $500 of that reduces what you owe. The rest, $1,300, goes to the lender as interest. This ratio shifts slowly over time. After 10 years, perhaps $600 goes to principal. After 20, $800. You're paying interest on a shrinking balance. But that balance shrinks far slower than you'd expect. The lender structures this intentionally. They front-load interest because it protects them. If you default in year 2, they've already collected significant interest. If you pay off early, they lose projected earnings. Some mortgages include prepayment penalties, fees for closing the loan ahead of schedule. Others allow it freely. The terms vary, but the core mechanism remains. Time and compound interest work in the lender's favor for decades. Your monthly payment also typically includes escrow, money held in trust for property taxes and homeowners insurance. The lender requires this because they hold the deed as collateral. If you stop paying taxes or insurance lapses, the property's value and their security diminish. So they collect these costs upfront, bundling them into what's called PD, principal, interest, taxes, insurance. Your actual cost of borrowing is higher than the interest rate alone suggests. Over 3 decades, the compounding effect becomes visible. That original $300,000 loan at 6% costs roughly $600,000 in total payments. You've paid twice the principal in interest alone. Shorter loan terms, 15 years instead of 30, reduce total interest substantially, but they increase monthly payments. The trade-off is mathematical, not emotional. The system works the same way whether you're aware of it or not. Amortization ends in one of 2 ways. You pay the final installment and own the property outright, or you default and the lender forecloses. Most mortgages are sold on the secondary market, bundled into mortgage-backed securities and sold to investors. This means the lender who originated your loan often isn't the entity collecting your payments, but the amortization schedule they created persists unchanged. It's a contract between you and mathematics. Understanding how a mortgage works, from origination through amortization, reveals the mechanics beneath one of the largest financial commitments most people make. The structure isn't hidden, but it's not intuitive either. It exists because it benefits lenders. Knowing how it functions allows you to see the system clearly, rather than simply accepting monthly statements as inevitable. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for more breakdowns of how financial systems actually operate beneath the surface. Subscribe for more breakdowns of how financial systems actually operate beneath the surface. This video is for educational and informational purposes only and is not financial advice. Always do your own research.